The Programmable Lock on Bitcoin Capital. Bitcoin's script is now a programmable jail for $1 trillion of capital, without the assets ever leaving the main chain. While the world viewed Bitcoin as a static vault, Babylon has weaponized the UTXO model to act as a security coordinator for external networks. By utilizing native features like time locks and multi-signature requirements, the protocol forces Bitcoin to behave as a collateralized asset for proof-of-stake chains. This shifts the fundamental utility of the network from a passive store of value to an active security provider. Understanding this transition requires looking past the asset and directly into the remote staking logic. Remote staking without bridges. Traditional staking involves moving assets to a new chain, but Babylon operates through a mechanism called remote staking. It uses a series of Bitcoin transactions to lock funds on the base layer, while simultaneously providing a cryptographic proof of that lock to a secondary chain. There is no wrapped BTC, no custodian, and no bridge that can be exploited. Instead, the protocol relies on the Bitcoin timestamping service to synchronize the state of external proof-of-stake chains with the Bitcoin ledger. If the validator on the secondary chain misbehaves, the Bitcoin locked on the mainnet is the designated penalty. This engineering choice avoids the bridge risk that has resulted in billions in lost capital over the last 5 years, but it introduces a new complexity in how slashing is actually executed. The extractable signature trap. The primary technical hurdle for Bitcoin staking was the lack of smart contracts to handle slashing, but Babylon solved this using extractable one-time signatures, or EOTS. Think of it as a cryptographic trapdoor. When a validator signs a block on a consumer chain, they use a specific type of signature. If that same validator attempts to sign a conflicting block, a double sign, the two signatures combined reveal their private key to the public. This allows the protocol to programmatically burn or lock the offender's Bitcoin on the mainnet without needing a central authority. It is an elegant engineering solution that turns the validator's own private key into the collateral. This mechanism creates a direct economic link between Bitcoin's security and the integrity of smaller app chains, effectively allowing new networks to lease Bitcoin's massive economic weight. Securing the Appchain perimeter. For an emerging proof-of-stake network, the cost of capital to secure the chain is often its biggest barrier to entry. By plugging into Babylon, these networks can replace high inflation rewards with the security provided by existing Bitcoin holders. This creates a market where security is a commodity that can be rented rather than built from scratch. It is a fundamental shift in how decentralized networks are bootstrapped in 2026. The technical trade-off is the unbonding period, which is dictated by Bitcoin's block times, creating a unique liquidity profile for these staked assets. The commoditization of security. The real implication of Babylon's architecture is the transformation of Bitcoin into the base layer for global cryptoeconomic security. By solving the slashing problem through EOTS and avoiding the systemic risk of bridges, the protocol has effectively turned Bitcoin's dormant market cap into a functional utility. This moves the industry toward a future where security is not a siloed resource held by individual chains, but a liquid commodity provided by the largest pool of capital in the space. For developers and fund analysts, the metrics that matter now aren't just transaction volume, but the security density of these consumer chains and the integration depth of Bitcoin liquid staking tokens. The experiment moves from theoretical to systemic, as more ZK rollups integrate Bitcoin-backed finality into their designs. Watch for the first major slashing event on a consumer chain to see if the EOTS mechanism holds up under real adversarial conditions during the third quarter of 2026. Subscribe for more.